We currently have 7 Airbnbs spread out around the Southeast. We have 2 in Nashville, Tennessee, 2 in Gatlinburg, Tennessee, 1 in the North Carolina mountains, and then 2 down in Fort Lauderdale, Florida, and we're setting up our 8th also in the same location in North Carolina as that other one is. We started this journey back at the end of 2019, and we just completed our 4th full year operating short-term rentals on sites like Airbnb and Vrbo. And in this video, I'm gonna break down the exact amount of money we made in 2023 from 7 properties and what went right, what went wrong, and ultimately what profit we were left over with. Our 7 properties brought in $1,032,840 in 2023, which is amazing. We finally crossed that 7-figure mark. And what's awesome is this is just with 7 properties. And as you guys see when I go through these numbers, our strategy going forward is absolutely quality over quantity. What we've noticed with some of our more average properties, 3 years ago, they were above average, but as competition has increased, they've kind of fallen down into more of the average category. And then our premium properties are continuing to outperform and bring in some insane numbers. The worst performing property, we actually had a negative cash flow. Yeah, and it really pains me to say that, but I'm gonna be honest with you guys about the numbers. This was a property that we paid for at the peak of the market. We had just done 3 cash out refinances on 3 of our properties, and we were looking to acquire a few more. And this property cost us $1.5 million, put 15% down on a DSCR loan, so it was much more expensive mortgage payment. It's close to $9,000 a month. And it brought in like 162 grand, and the mortgage alone was $108,523 throughout the year. And then pair that with cleaning and other expenses, we were at a loss of $8,439. Now, this isn't a total loss as an investment. Yes, the cash flow is negative, super disappointed about that. In part due, probably to me, didn't manage it quite as well as I did in the years past. But the principal pay down on the loan was over 18 grand. And that doesn't include appreciation and then the depreciation as well. So it's still a good investment, but it's not a great investment. It's certainly not on par with what I'm seeking with my short-term rental properties. Now, with that being said, our best performing property was our most recent one with the highest interest rate that we acquired in 2023. Now, this one we went all out with the experience. We put in a pickleball and basketball sport court. You guys have probably seen videos on this. If you haven't, look back on my older videos. I do a whole breakdown and walkthrough of the property, and we launched it at the very end of April. So May was a ramp month, and then June we finally started to get a bunch of bookings. And in just those 8 or so months, it brought in $226,000, which is insane. And this year in 2024, we're already on pace to get close to 400 grand for the whole year. And what's wild is the mortgage is less on this one because we bought it at $980,000, so way less than that Fort Lauderdale property, but our mortgage is lower. We paid close to 50 grand in mortgage expense, and then we had cleaning and other expenses, and our total profit on this was $103,433. So you have our worst and our best properties. The others are kind of mixed in the middle there. Our total cash flow or profit on these properties was $226,571. And so if you do the math on that, this is insane to think about. That one property, which is in North Carolina, that did 103K cash flow, accounted for 45.65% of our entire portfolio's cash flow. That's pretty wild to me. And it just goes to show that if you go all out with one property, it's better than getting 3 or 4 mediocre properties. Now, a few things that dampened our overall cash flow, because if you guys have followed me for a while, last year we did like $360,000 total cash flow. Some of our units came down off the 2022 peak, which is the post-COVID travel boom. Understandable, I expected that to happen, but not quite at this level. Now, one of them in Nashville, our first ever one, we needed to redesign. So we actually blocked off the calendar for a month and a half. Summer-led Designs came in and just knocked it out of the park. And this has already proven to show drastic improvements in the daily rate and occupancy. We have increased our daily rate on weekends by upwards of 50% on peak weekend nights. So we're getting booked close to $1,500 a night, and as far out as October of this year, which is insane. So what we had noticed was our booking lead time was shrinking. Our average daily rate was going down a little bit. And just because competition has increased, and this place is not in the heart of downtown. So we had to really go all out with the theme. We themed it Bachelorette themed. And so far it's, we got $50,000 in bookings just within the first 3 to 4 weeks of the relaunch, which is amazing. And then one of our big Gatlinburg properties in the Smoky Mountains that has done incredibly well in years past, that property had so many maintenance problems. And this is another note to self and to you guys out there. If you buy older properties, just beware that you're probably gonna have a lot of maintenance bills. And we were fortunate the first year or two that we had it, we didn't really have a ton of maintenance, but this year we got hammered. We even had a big electrical issue that not only cost us I don't even know, I think the total maintenance I wrote down here for the year was $28,000 almost. And then we had 2 weeks that we had to cancel bookings. July is the busiest season of the year in the Smokies. So 2 weeks of canceled bookings and a $28,000 maintenance bill for the year really hammered us on that property. That property only cash flowed like 14 grand this year. And in years past, it has been in the 6-figure range. So kind of crazy to see the big swing there. But that was one of the properties we did a cash out refi on, did a big rehab on. So we actually pulled out like 200% of the money invested. So honestly, any cash flow on that one is infinite return. So we're still happy there. And I think this year we're going to see that bump back up, assuming we don't have tons of maintenance issues. Total revenue from bookings, $1,032,840. Total amount paid in mortgages was $428,761. Total amount we paid to our cleaning teams, $161,145. And then all other expenses, including maintenance, utility bills, permitting, stuff like that, $216,363, leaving us a cash flow of $226,571. And the principal pay down on the loan, you guys, because it's not just cash flow. Cash flow is what will set you financially free. That's what gave us, my wife and I, the lifestyle that we can afford today. But the principal pay down on the loan, the appreciation long-term, and the depreciation on the asset is what is going to build your wealth. So just the principal pay down on the loan last year totaled $65,069. So that grew our net worth just from our guests, the revenue, right, paying off the mortgages. And that does not include any appreciation. And then depreciation is going to reduce our tax liability. And this year we should be paying 0 in taxes. We actually should have a refund because we did a cost segregation on the one property that we launched, that big one in North Carolina I mentioned. And for those that don't know what a cost segregation study is, go check it out online. But basically this looks at the property and a team of engineers goes out there and categorizes everything, whether it's light fixtures, plumbing, electrical, furniture, and they bucket each of those off and each have different respective depreciation schedules. Now, what you're allowed to do is do a bonus depreciation on that amount. And in 2023, you're allowed to bonus depreciate 80% of it. Now, there is a bill that should be getting passed, a bipartisan bill, that would allow us to actually go recapture and do 100% bonus depreciation. But assuming the 80% just on that property is about $380,000 in depreciation, that again reduces our tax liability. So that alone, even if it's just 80%, we have well over what we actually made in cash flow. So we should pay nothing in taxes on that profit we made. And if it goes back up to 100% bonus depreciation, it should be closer to that $475,000 range. So this is why we invest in real estate. The cash flow sets us financially free. The appreciation and principal pay down builds us our wealth and equity long term. And the depreciation allows us to pay less in taxes each year. All right, so here are the lessons learned from 2023 and what my plan is in 2024. Lessons learned: we have to stand out and go all out on amenities and design and differentiation. If you guys are not differentiating yourself from competition, it is going to be, very average performance. It's going to be a race to the bottom considering price to secure bookings from travelers out there. The top 5 or 10% are always going to get found online. They're always going to get booked, and they're going to get booked at a premium because people are willing to pay for a premium experience. So what can you do on your properties? Go to AirDNA, look at the top performers, make a list of all of the top or common amenities that they have. This is probably going to be things like a hot tub, a pool table, game room, sauna, whatever. And then make a list of the outrageous amenities that nobody else has that you can add on top of that. If you can combine those two things, you guys will dominate your competition as long as you are priced correctly. Our most recent property is proof of that. So I cannot recommend that enough. That's something we're gonna be focused on, is quality over quantity. We're only gonna look to acquire 1 to 2 properties personally each year, but they're gonna be big properties that makes it very hard for people to compete with us. The second thing I'm focused on is probably going to think about selling our Florida properties at some point. I've already made a lot of changes to how we price it and market the properties, and we've seen a big uptick in reservations. That one property that lost $8,500 last year, every single weekend is booked through May, and it's January. Now, it is busy season in Fort Lauderdale, but last year we did not have that kind of reservations and booking lead time. So I'm very bullish on the fact that we're gonna perform better this year than last year, but I still think I may sell those 2 properties that are performing a little bit worse and then do a 1031 exchange and move them into 1 or 2 monster properties like that North Carolina one that can yield such massive cash flow. So there's some consolidation consideration going on, but other than that, the strategy remains about the same. For me, you guys. Hopefully you guys appreciate this video and appreciate the transparency. I'm gonna show you guys the good, the bad, and the ugly as it occurs. And if you like this type of information and find it useful, please give it a thumbs up, hit the like button, and then subscribe to follow along for future content.